Last month, I said I would tell you about one of the 3 reasons that dividend income goes up steadily in a dividend growth portfolio. I got 7 of them in September, so this is a good time to focus on dividend increases. Hi, I'm Dave Van Knapp for the Dividends and Income channel. Before I get going, please help us out by clicking the thumb up button if you like this content, subscribing to the channel, and ringing the bell so you get notifications when we put new videos up. Thank you. I'm trying something new this month. To make the portfolio review less dry, I'm adding a special feature to improve the teaching value of these reviews. If all you're interested in is the portfolio itself, I'll put that up near the end of the video, and you can pause it there and study it to your heart's content. But first, here's the feature part of the video. As I said, the portfolio got 7 dividend raises in September, and they are shown on this slide. You see the 7 companies in the left-hand column. In the far right column, I highlighted each company's annual income in yellow to emphasize the fact that those are all new numbers because of the dividend increases. And I want to call 2 of these companies out, McDonald's and Realty Income. You can see in the second column, I've circled the dates 2008. That column shows the first year in the portfolio, and I'm calling them out because I've owned these companies since 2008, which was the year that the portfolio started. So I've held them for 13 years, and I think they're worth a special mention for that reason. Let me say, by the way, at this point, that it's great to see investment decisions made long ago hold up and still be paying benefits more than a decade later. I hope this serves as encouragement to younger investors to stick with your plan. It will pay off down the road. This display shows the quality snapshots for those 2 companies, McDonald's and Realty Income. You can see that McDonald's has almost all green grades and totals 22 out of 25 points on its quality snapshot, which is a very high quality company. Realty Income comes in at a good, solid, investable 17 points on a 25-point scale. Both companies are dividend aristocrats and dividend champions. McDonald's has a dividend growth streak of 46 years, and Realty Income's is at 26 years. That means that for those lengths of time, each company has raised its dividend every year without fail. In my portfolio, I keep track of the increases each year in what I call my dividend increase tracker. I've reduced the entire table to the 7 companies that raised their dividends in September. So you see the same companies here, and I've highlighted McDonald's, and you can see how I do it. I list the increase that was just declared, what month it will be payable in, which in McDonald's case is December. The increase amount was 7%. And then I put a comment, and the comment here was a jump from last year's 4.3%. Clearly that is McDonald's recovering, as many companies are, from the lowered money flow they had in 2000 as a result of the pandemic. At the bottom of the slide in the second column, you see that year to date I've received 30 declarations of increases from the 30 companies in the portfolio, and I'm still expecting 1 or 2 more before the year ends. I'm calling out the 7 raisers to remind you that dividend raises are one of the holy trinity of reasons that dividends grow over time. This diagram shows the 3 reasons that dividends grow over time in a dividend growth portfolio. Number 1 is dividend increases themselves. That's what we've been talking about. The companies in the portfolio announce regular raises. As I just mentioned, so far this year there have been 30 raises in the portfolio, and another 1 or 2 are still expected. Reason number 2 is something in your control. You can reinvest the dividends. What I do is I collect the dividends in cash and reinvest them once a month, and I do a video once a month to tell you what I bought and why I bought it. Reason number 3 that dividends grow in the whole portfolio is again something that you have control over. You can make adjustments in your portfolio. I made a big one this year when I sold out of AT&T and reinvested the money in other companies. I occasionally make trims and replacements of that kind, and usually they result in dividend growth. A typical portfolio management move for me would be to trim a stock that has become oversized and replace it with a stock that is a smaller size in the portfolio but is paying a higher dividend. That kind of trim immediately increases the annual dividend cash flow from the portfolio. And that's the end of this month's feature content. Let me know if you like this kind of stuff in the comments below. I'm also considering highlighting a particular stock each month, and please let me know if you would like that or other ideas you may have. Okay, let's move on to the portfolio update. Here are the highlights of what happened in September. Number 1, as I said, 7 out of the 30 stocks declared dividend raises. Number 2, my portfolio investment this month was in the middle of the month a couple weeks ago, and I bought 4 shares of AbbVie via dividend reinvestment. Number 3, because of that buy and because of all the raises I received, the annual run rate of dividends went up almost 2% in September, and that's a pretty big increase for a single month. Highlight number 4 is more than half the companies in the portfolio paid in September. So that's different from declaring raises, which companies do once a year. The payments normally come once a quarter, and the payments have their own seasonality to them, which I'll illustrate in a minute. It so happens that September, being the first month of a quarter, is the highest dividend paying month for me, the way the stocks in my portfolio work. So more than half the companies in the portfolio, 16 to be exact, paid out in September, and I collected $613 from those stocks. And highlight number 5 is that my yield on cost hit 11.1%. So it's made up almost all the ground that I lost when I sold AT&T earlier in the year and didn't at that time make an effort to replace all the income that AT&T was giving me. This chart is my favorite chart. I show it each month, and each month it keeps getting better and better. The reason it's my favorite chart for my portfolio is because it illustrates the successful attainment of the main goal of the portfolio, which is shown in green up at the top, and a little legend that says reliable, steadily increasing stream of dividends. That quote comes right out of the business plan for the portfolio. This chart illustrates how that's been achieved, starting when the portfolio began in 2008. If you look at the bar near the right edge, labeled 21 estimated, that shows that more than $5,000 is now my estimate for the total dividends from the portfolio this year. The maroon dot within the bar shows the year-to-date total, which is now over $3,900. And to the far right, for the first time this year, I've added an estimate for 2022, and I didn't do anything super scientific or hard. I simply added 8% to my expected total for this year to make my first projection for 2022. 2021 will be the first year that dividends exceed $5,000. It took just 2 years to get from $4,000 to $5,000. The dollar growth in the portfolio each year is accelerating because the percentage of growth each year is being applied to a larger and larger base. That's how compounding works. This display comes from E-Trade, which is where the portfolio is held. You can see in the upper left corner that the estimated annual run rate for the portfolio now is $5,177 per year. As raises are increased and as I keep reinvesting dividends, that amount goes up and up, as we saw in the green bar chart. This display also shows the seasonality of the dividends in this portfolio. By seasonality, I mean that in each quarter of the year, there's a pronounced pattern of how the dividends run. You can see that October is a low month, November is a medium-sized month, December will be a high month in terms of dividends from the portfolio. And then next January, we'll drop that back down to low month, medium month, high month. That pattern is repeated 4 times a year in my portfolio. The monthly variations are simply the result of the payment schedules of the particular companies that I own. They don't have any other broader significance. I have never selected nor have I ever turned away from a stock based on its dividend payment schedule. This display shows the yields of the dividend growth portfolio. That's plural because I track 2 yields. I track the current yield, which is shown across the first row in the table, and I track yield on cost, which is shown in the second row. And I've presented it this way this month for the first time because I think it makes a little clearer where those numbers come from. A yield is always an amount divided by another amount. In the case of dividend yield, it's an amount of dividends being received, and the divisor is the size of the portfolio. For current yield, the annual income, which we saw on the chart from E-Trade, is $5,178, is divided by the current value of the portfolio, which is $158,918, and that gives a current yield of 3.3%. Current yield is the yield you would get if you duplicated the portfolio right now. Over the years, the DGP's current yield has ranged between 3.0 and 4.2%. Those variations are not significant. They primarily reflect prices going up and down because the current yield divisor is the current amount of the portfolio. As a value in the portfolio goes up and down, as the stock market goes up and down, that can change the yield number without changing the pattern of rising dividends. The dividends are going up. The yield wavers and oscillates with the value of the portfolio. For comparison to the DGP's 3.3% current yield, the S&P 500 currently yields 1.3%, and the benchmark 10-year Treasury is yielding 1.6%. The second row in the table shows yield on cost. The numerator in the equation is the same, the annual income, $5,178, but the denominator is different. The denominator in yield on cost is the portfolio's original value when I started it in 2008, which was $46,783. When you do the math, that comes out to a yield on cost of 11.1%. This number, yield on cost, does reflect the amount of the dividends coming in. And at 11.1%, this is up 0.2% since last month, which is the result of the reinvestment that brought 4 more shares of AbbVie to the portfolio, combined with the slew of dividend raises that were announced in September. At 11.1% yield on cost, the portfolio is now sending me in cash each year dividends at the rate of 11.1% of my original investment back in 2008. That's the end of this month's review. Now I'm going to keep my promise and display the portfolio. If you want to study it in detail, just hit pause and you can take as long as you want with it. While you're looking at the portfolio, let me just tell you that the aqua highlights pertain to the AbbVie shares that I bought in September, and the yellow highlights indicate the new annual dividend amounts from the 7 stocks that declared dividend increases in September. And that's the story for this month. Thanks for watching. Remember to click the buttons, and I'll be back soon to tell you about another great dividend growth stock. Bye, everybody.